Welcome back to the Global Ledger. I am Justin. Today, we are clearing the air on one of the most persistent, confusing, and honestly, fear-creating ideas in finance. And that is the Fed prints money. You hear it on the news, you hear it online, you hear it from people who should know better. You even hear it from some economists. But does the Fed actually print money? And if not, what does the Fed do? And why does this myth cause so much confusion and unnecessary fear? That's what we're breaking down today. Let's begin. So first of all, I want to kind of discuss, I think would be helpful to set the stage as to where the myth comes from. And when most people hear print money, money printing, whatever, they imagine a giant machine at the Federal Reserve cranking out dollars and somehow injecting them into the economy. It's a powerful image, very simple, dramatic, and intuitive, of course. But the actual system doesn't work that way. In fact, the Fed does not, in any way, create deposits in your bank account, hand out spendable dollars, or print money that circulates in the real economy. It doesn't even touch most of the money people use day to day. And the first key insight is this: the Fed doesn't print the money you use. Banks do. The Fed prints something else entirely. So what the Fed creates is a very specific kind of money, a kind most people never see. You and I, anyways. So what does the Fed create? So if the Fed doesn't print spendable money, then what does it create? It creates bank reserves. And here's the simplest way to think about it. Reserves are money for banks. Deposits are money for people. Reserves live inside the banking system. Deposits live outside the banking system. So if you try to spend a reserve at the grocery store, nothing happens. They're just not connected. Reserves aren't used for buying groceries, paying rent, or filling up your tank. They're used for one thing, and that's settling payments between banks. That's it. So reserves are the internal, say, accounting layer of the financial system. Another way to say it, it's part of the plumbing. And the Fed creates reserves by buying treasury securities, lending to banks through the discount window, or another one would be provide repo funding, which we'll have a different discussion on repo as we get more into the series. But none of this is printing money in the everyday sense. So I think a good segue would be to talk about where the myth gets really loud, and that's quantitative easing, QE for short. People say quite often QE is money printing, but it's just not accurate. In QE, the Fed buys a treasury from a dealer or investor, takes the treasury onto its balance sheet, and pays for it by creating reserves. But notice what does not happen. No new deposits are created for households. No money enters the real economy. Nothing is handed out. No printing machines are, quote, turned on. So all that happens is dealers swap a treasury for reserves, asset composition changes, collateral availability changes, funding conditions also change, Certainly liquidity dynamics shift, yields adjust, but the private sector's net worth does not change. This is really just an asset swap, not money printing. So let's talk about the second major myth. So if the Fed prints money, inflation happens. But inflation isn't caused by reserves. Reserves don't chase goods. They don't buy houses, and they don't bid up stocks or groceries. What can influence inflation is fiscal spending by creating deposits, supply shocks, and commodity cycles too. Global dollar liquidity is one. And of course, wages and labor market tightness. But Fed reserves, no, they mostly stay trapped inside the banking system. So they keep the pipes flowing. They don't spill. How do I say this? They don't spill into the streets. So who actually creates the money that we use every day? If the Fed doesn't print money, then who does? And this is commercial banks. So when a bank makes a loan, it simultaneously creates an asset, which is the loan on the balance sheet, and a deposit, which is the liability, your money. So that deposit, the balance in your account, is money. This is why the saying goes, loans create deposits. So most of the money in the world, something like 95%, I think, is created not by the government, not by the Fed, but by the banking system. So banks create spendable money. The Fed creates reserve money. Two different layers, two different functions, two different implications. So we're going to get into banks and kind of tie these arguments in and further down the series. But another important thing to talk about in this regard is the question is, well, so if the Fed doesn't print money, what's its real power? And the power of the Fed comes with supporting dealer balance sheets when stress hits. So, and it does this by providing reserves. It can lend against collateral. It can stabilize funding markets, and it can activate swap lines for offshore dollar demand. And in doing so, it keeps the global dollar system functioning. And so you've heard the terms dealer of last resort. I learned about that through Perry Maryling. Liquidity backstop, balance sheet stabilizer, but not money printer. So I always like to connect these episodes somewhere with finance. And so I want to connect it up with valuation in markets and discount rates. I think would be the first thing I'd talk about. So the backbone of any valuation model, like we've discussed before, these are shaped by funding conditions, liquidity, risk premiums, dealer balance sheet capacity. So when the Fed stabilizes reserves or funding markets, it stabilizes dealers, which stabilizes liquidity, which then stabilizes discount rates. So that's the pathway. It's not money printing; it's balance sheet engineering at its core. So and this is basically monetary operations to liquidity conditions, dealer capacity, discount rates, valuation, asset prices. That's kind of the short chain or the long short chain, I'd say, of it. It's a mechanical story, like I've said before, not a dramatic one. So I'm going to leave it at that because there's a lot to unpack in a lot of these things we talked about, and I will go into detail on some of those specifics. But here's the real reason I wanted to record this episode. The phrase "the Fed prints money" makes people afraid, and it made me afraid. And anybody that is concerned with their economic and financial situation probably may concern them as well. And fear really does spread fast. This is something I've learned the hard way. But once you see the actual plumbing, the balance sheet mechanics, the distinction between reserves and deposits, and the role of dealers, my hope is that the fear disappears. And you understand what the Fed can do, what it can't do, and what actually moves markets. You don't need ideology. You don't need any drama. You could say you just need the ledger. So thanks for listening to episode 4. We touched on some really important myths and tried to unpack some of those myths. Extremely misunderstood, and we tried to take it head on, looking directly into the system. So next episode, I think, is going to be fun too, because we're going to talk about how money is actually created, and I'm going to give a real world example on this that touches, I think, everybody that has ever bought a home. So this is the real process, the structure of promises, the layers of par, and pretty much the mechanics behind what's going on. So if you enjoyed this episode, share it with someone who wants clarity instead of chaos. Thanks for being here.